Welcome to the Deep Dive. This is Talk Tickers, your shortcut to understanding the most impactful earnings calls. Today, we're tearing into the second quarter 2025 earnings call for the Beachbody company, ticker BORD. And this isn't just another quarterly report. It's really a deep dive into a company dramatically reshaping its whole business model, the market's reaction. Well, it was a pretty clear signal of cautious optimism. It suggests investors are, seeing some promise in this ambitious strategic overhaul.
Oh, definitely. It's truly a fascinating case study in corporate transformation right now. Beachbody is actively shedding its legacy and kind of rebuilding for the future.
Yeah.
And these Q2 results, they give us a critical snapshot. They show us the early wins, but also the ongoing challenges of that pivot. We're really looking at a classic turnaround story. And the details from this call, they just provide a rich landscape for our deep dive today.
Okay, so let's unpack those Q2 results then, because they really did surprise to the upside. The Beachbody company actually beat analyst estimates on both GAAP EPS and revenue. Now, for those less familiar, GAAP EPS, that stands for Generally Accepted Accounting Principles Earnings Per Share. It's essentially a standardized measure of profit per share.
Exactly. And beyond that, they reported adjusted EBITDA of $4.6 million. That's earnings before interest, taxes, depreciation, amortization, but adjusted for one-off costs to give, a clearer picture of core operational profitability.
Right.
What's really significant here is this marks their 7th consecutive quarter of positive adjusted EBITDA.
7th. Wow.
Yeah, a streak that really underscores the recent focus on efficiency.
And that's a powerful trend. Now, revenue, it did come in at $63.9 million, which was better than expected.
Right.
But, and this is important context, it still represents a year-over-year decline of 42%.
Right, and that revenue contraction, it's actually anticipated. It's quite deliberate, in fact. It's a direct consequence of the company's strategic pivot, which we'll definitely get into. The key takeaway for now is the market's strong positive response after the announcement. This suggests investors are prioritizing Beachbody's profitability path and strategic direction over that immediate top-line growth. Yeah. You're seeing the long game here.
And that long game, especially on the financial front, that's where it gets really compelling, I think. Let's dive into this financial transformation because despite that revenue drop you mentioned, management's core message was one of, dramatic financial discipline. They've aggressively restructured their costs, pushing their revenue break-even point, get this, from a whopping $900 million back in 2022 down to an impressive $200 million projected for 2025.
That's huge.
That's not just cutting costs, it fundamentally de-risks the entire business model.
Absolutely right. That massive reduction in the break-in point is such a critical indicator of operational resilience. It means Beachbody can now generate profit at significantly lower revenue levels. Makes them far more flexible, less vulnerable to market swings.
Yeah, much stronger foundation.
It provides a much stronger foundation, even as they navigate these short-term revenue pressures. And a big piece of this story is sustained margin expansion. Their gross margin, for instance, improved significantly to 72% for the quarter. That's a 300 basis point increase year over year.
Okay, 300 basis points. So for clarity, a basis point is 1/100th of a percentage point. So a 3 percentage point jump in gross margin. That's substantial.
Very substantial. And they didn't just hit that mark. They actually raised their long-term total gross margin target. It's now 70-75%, up from their previous 65-70%.
Wow. And what about digital margins?
Even stronger. Digital gross margins hit 87.7%. And that long-term target was also raised, now sitting at 86-89%.
Okay, so what's driving such impressive margin improvements across the board?
Well, these elevated margins are a direct reflection of that business model shift we talked about, and also a much more disciplined approach to content production and managing their fixed assets. It's really about optimizing every dollar they spend and every product they sell. And hand in hand with that, operating expenses. They declined by 41.5% year over year to $50.2 million. Specifically, selling and marketing expenses as a percentage of revenue dropped pretty dramatically from 51.1% last year down to 39.9% this quarter.
And they have a goal to get that even lower, right? Into the mid-30s?
That's the goal, yeah. Mid-30s.
That's a huge shift in how they're spending on marketing. And if I remember correctly, this reduction is mainly because they're moving away from that multi-level marketing, the MLM compensation structure,
right,
which historically had much higher partner commissions.
Exactly. That's the primary driver. Right. This isn't just, trimming a bit of fat here and there. It's a fundamental change in their distribution and compensation strategy.
A profound structural change, really.
It truly is. And its impact goes beyond just marketing expenses. This leaner model is also allowing them to tackle legacy issues, like their debt load, with renewed vigor. The company refinanced its debt with a new $25 million three-year loan. That reduced its effective interest rate from roughly 28%, which is quite high,
Ouch.
down to about 15.4%. Still not cheap, but much better. And this immediately boosted their cash balance from $18 million to over $25 million.
Okay, that helps the balance sheet.
Definitely. But the most significant financial milestone, at least in my view, is that the Beachbody company generated $4.1 million in positive free cash flow year to date.
Right. And for those keeping score at home, free cash flow. That's the cash a company generates after paying for its operations and maintaining its assets, often seen as a real measure of financial health. So, achieving positive free cash flow and having line of sight to full year positive free cash flow for the first time since 2020, that's a really big deal for them.
It is absolutely a critical indicator for any company undergoing a turnaround like this. It signifies, self-sufficiency, financial stability. Now, we should also provide some context for their Q2 net loss, which was $5.9 million.
Okay.
That figure included about $2.5 million in restructuring charges and another $2.2 million loss on the extinguishment of debt.
Ah, okay. So these weren't typical operational losses then. They were more like one-time costs directly tied to the transformation itself. It's sort of the cost of tearing down the old wall to build that stronger, more efficient structure you mentioned.
Precisely. Well put. These expenses are symptomatic of a company in transition, rather than a reflection of ongoing operational underperformance. They're a necessary part, really, of shedding the old model and building the new one.
So, okay, we've rebuilt the financial house, maybe with some demolition costs along the way. But what about the blueprint for the new Beachbody? How are they planning to reinvent their entire approach to growth? That brings us to their strategic pivot and future growth plans. Management really hammered home this ongoing shift from that multi-level marketing model to a single-level affiliate omni-channel approach. What exactly does omni-channel mean for their business in practical terms?
Right. So omni-channel basically means they'll engage customers through multiple integrated touch points. Think their digital platforms, these revitalized affiliate networks, and critically now physical retail.
Physical retail, that's new territory for them.
Totally new. This strategic shift is designed to simplify incentives, dramatically cut those legacy compensation burdens, and significantly expand market reach beyond their traditional direct sales base. Management highlighted that while, yes, this transition does impact near-term revenue, it dramatically improves the lifetime value of customers because it eliminates those recurring renewal commissions that were part of the old MLM structure.
Got it. So it fundamentally changes the unit economics, the profitability of each customer for the better. That makes a lot of sense. Now let's talk about a major growth driver they outlined, expanding those iconic Beachbody brands into retail. And this feels like a huge one. I mean, imagine Shakeology, their superfood shake with, over $4 billion in cumulative sales, making its first ever appearance in actual stores.
That's the plan. It's scheduled for limited rollout in grocery, mass merchandiser, and club stores, starting late Q1 2026. And this isn't just, sticking the same old tub on a shelf. It'll feature completely refreshed packaging designed specifically for that retail environment.
Smart.
Yeah, it's a significant move. They're leveraging immense brand equity in entirely new distribution channels.
And it's not just Shakeology, right? Following that, new P90X nutritional lines are set to launch in Q2-Q3 2026. They mentioned support from a brand new P90X fitness program and some innovative cross-marketing, like offering free workouts with product purchases. That sounds interesting.
It does. And then Insanity-branded nutritional supplements are planned for late 2026. So they're creating a full suite of retail offerings, tapping into their most recognizable, powerful brands.
Okay, so retail is a big push, but they're not forgetting their digital roots, are they?
Oh, definitely not.
Yeah.
Beyond retail, they're clearly still focused on digital. While nutrition revenue did decline because of the MLM transition, the company is sharply focused on driving digital subscriber growth. New content releases, like 25-minute speed train, apparently achieved over 1 million views in just 21 days. That's 50% faster than previous big program launches.
Wow, okay. So engagement is still strong there.
It shows their ability to still captivate and grow that digital audience, yeah.
And the content pipeline sounds pretty robust, too. I heard about upcoming stuff like licensing Tony Horton's Power of Four program in October and a new hybrid program from Sean T, Dig In, time for Black Friday, Cyber Monday, supported by large test groups, apparently. And then a new P90X Generation Next program with a new trainer slated for spring 2026. It seems like a consistent stream of fresh content is key to their digital strategy.
Absolutely vital for attracting and retaining subscribers in that space. And to support all this, they're strategically investing in technology. They're replatforming their affiliate program with a system called Social Ladder, launching an Invite a Friend, feature focusing on user monetization and community building.
Makes sense.
Also, there's CRM initiatives, customer relationship management, basically improving interactions with customers, and a transition to Shopify's AI-enabled commerce platform by spring 2026. Those are aimed squarely at improving conversion rates and personalization.
Okay, so those tech investments seem crucial for optimizing this new omni-channel model they're building. Now, looking ahead just a bit, to Q3 2025, the company provided guidance. They expect revenue between $51 million and $58 million, adjusted EBITDA between $2 million and $6 million, and a net loss somewhere between roughly -$4 million and break even. So sounds like continued positive adjusted EBITDA, but still a somewhat muted top line as this business model shift really takes hold.
Yeah, this guidance implies, I think, a realistic view of their current trajectory. They acknowledge the ongoing top-line pressure from the transition, but they seem committed to maintaining profitability through that improved cost structure and those margin gains. It looks like a calculated strategy demonstrating discipline during a period of pretty significant change.
So zooming out a bit, what does this all mean for someone considering Beachbody's journey? I mean, their pivot away from MLM, that aligns with broader industry trends, right? We've seen other brands move away due to regulatory heat and just changing consumer feelings about MLM.
That's a great point. This isn't just an internal decision. It's really a strategic adaptation to a changing market landscape. And what's most telling, I think, is that immediate market reaction we discussed earlier. Investors seem to be clearly prioritizing the company's profitability path and cost discipline over those steep year-over-year revenue declines for now.
Yeah, the improved gross margins, that clear path to positive free cash flow, those are compelling narratives for potential long-term value creation.
Definitely.
So thinking about the future, the success of this turnaround feels like it hinges on a few key things. Flawless execution of these huge retail rollouts for Shakeology, P90X, Insanity.
Critical.
Effectively scaling that new, simpler affiliate model, and keeping those digital subscribers engaged with fresh content and good tech. Their ability to really leverage that incredibly strong brand equity in these new channels seems absolutely crucial.
Yeah, and this raises a really crucial question for the next, say, 18 to 24 months. Can they effectively transition their brand perception? Can they go from being seen primarily as a direct-to-consumer MLM to being viewed as a broader consumer packaged goods and digital subscription company? Their execution over that period will be the definitive answer.
Okay, time for our This Is Not Financial Advice segment. Always fun. Given Beachbody's big strategic pivot and those robust gross margin improvements we've been talking about, here's an idea for the adventurous among you listening. Consider, perhaps, a long-term call option strategy targeting significant upside by late 2026. Now, for those new to options, a call option basically gives you the right, but not the obligation, to buy a stock at a set price by a future date.
Right. And the outrageous element here is really the implied market re-rating we just touched upon. Bodhi, currently trading at a single-digit price, has historically underperformed, arguably because it was viewed through that legacy MLM lens.
Yeah, that model comes with baggage in terms of valuation multiples.
Exactly. It limits its valuation, often seen as higher risk, maybe deserving a lower multiple.
The plausible angle here relies entirely on the successful execution of those retail launches, Shakeology and P90X hitting shelves effectively in 2026. I mean, these are billion-dollar brands entering entirely new channels for the very first time, backed by new content and that simpler affiliate model. If retail traction really materializes, you combine that with those higher gross margins they're targeting, 70-75%, and consistent free cash flow generation, well, the market could completely re-rate the DUI.
It absolutely could. It might start to view it more like a CPG consumer packaged goods company or a digital subscription player rather than just its former MLM identity. That shift in perception, plus leveraging that massive brand equity in new ways, could lead to substantial, though definitely long-dated, capital appreciation way beyond current expectations. Now, obviously, this strategy inherently carries high risk, let's be clear on that. But the catalysts for potential dramatic reevaluation are clearly being laid out through this strategic shift.
So, wrapping up, what we've seen from the Beachbody Company's Q2 earnings call is really a narrative of intense strategic transformation. It's aimed at building a stronger, more diverse, and crucially, a profitably growing company by the end of 2026. The path seems clear on paper: cost discipline, margin expansion, and that bold move into mainstream retail, leveraging those powerful legacy brands. So, as you consider all this information, what aspects of this ambitious transformation stand out to you as the most critical for their long term success? Will the retail gamble be their defining moment, or is the underlying digital pivot and margin story the real key? Something to think about. And remember, this discussion is for informational purposes only. It is absolutely not financial advice. Thank you for joining us on the Deep Dive with Talk Tickers.